But yeah, what was that first question? So yeah, Jennifer had emailed in and she said, hey, you talk a lot about stocks. I do. I call them equities, but what about in retirement? I don't want to lose money. So it's a very common thing here that people worry about. And, hey, we heard when you're young, where you're supposed to, invest in stocks. And then as you get older, you dumb it down, right? And you invest more in conservative things, more in bonds and CDs and those types of things. And what about retirement, right? I don't want to lose money. Okay, so two things. One, I always call them equities, not stocks, because when I think of stocks, I think of the nebulous stock market, which doesn't mean anything to anybody. And when I think of equities, I think of, hey, the equity you have in your house, right? And as that grows, you have more equity or more ownership in that house. And eventually you have 100% equity, 100% ownership in that house. So when we invest in the stock market, it's not this weird thing. It's not gambling, right? It's not this weird thing that we don't have control over. You are buying ownership shares in the best businesses in the world, right? And as business owners, that means when your businesses do well, you make money. And when they go through rough times, you go through rough times, right? That's part of being a business owner. But let me phrase it this way. And actually, I cover this in my first book, 3D Retirement Income, which you can also get for free if you want, or you can just buy it if you don't want to give us your email. That's fine. And I talk about this in here, but I think it's a helpful framing for a lot of people. So let's say that you bought a house some time ago, right? So you got a little house, got like a roof, got a couple windows. Maybe it's a 2-story house. You get that, got a little door. So you got your house, and you bought it for let's say $200,000, whenever this was, some time ago. And you decide, hey, it's time to, we've been here long enough. It's time to sell. It's time to move. And we're trying to move on, right? And so we sell that, or, we look on Zillow. It says we're this. We talk to a realtor. They post it. And they decide, hey, we think we can get $400,000 for it. And so you list it for $400,000, right? So you paid $200,000. That's your cost basis, right? Which we just talked about in the other thing. So you paid $200,000 for it. And now we think it's worth $400,000, right? Question for you. Does the value of your house just go straight up like that? No, right? The value of your house is only worth what someone's willing to pay for it, right? And that changes based on market conditions, based on who wants houses, supply and demand, all these things. So the value of your house actually did something like this over that time. You just didn't see it, because maybe you check Zillow once a year or once every few years or never, right? And so you mostly just maybe saw it here, maybe you saw it here, maybe you saw it here, and it was actually at a really low point. You just didn't know because the last time you checked, it was still above there. And you're like, hey, sweet, my house is improving. And then you checked it here and you're like, whoa, that's awesome, and here, and then at the end. And so you didn't see the ups and downs because there isn't a TV above your door where every day it tells you how much your home is worth. Right, so you list it, you put it on the market on a Thursday. Over the weekend, a bunch of people come in and look at the house, right? And you said, hey, we're gonna have it for the weekend. We'll look at offers over the weekend and we'll get back to you on Monday. So a bunch of offers come flooding in, and for all over the place, some higher, some lower, but the best offer you get is for $420,000. And so, like, literally overnight, you went from thinking you had 400,000 to 420,000. Right? Question for you. Have you made, right, if we paid 200 for it, have we made this difference here? Have we made $220,000? No, not yet, because we haven't sold it yet, right? This is what would be called unrealized gain, right? If we look at from zero, this is zero, right? We paid 200 for it, and now we've got, again, same thing. All this would be tax-free, and since it's your house, the rest would be tax-free too. Here's your cost basis. Here's your capital gain, right? This would be unrealized. You haven't actually sold it. You haven't actually made any money yet. But you're like, well, hey, we definitely want to do this. We just made an extra 20 grand overnight. This is awesome, but we should sleep on it like smart people do. Maybe pray about it, talk to our spouse, etc. And overnight, storm rolls in and lightning strikes your house, or strikes the tree next to your house. Branch comes down, caves in the roof, etc. And you're like, that's no good. Big storm, bunch of trees down. Everyone hears about it. They're like, hey, isn't that the house we just put an offer in? They come back. They see the damage to your house. They're like, whoa, we don't want that house anymore. And they pull all their offers. So before you can accept it. So you're like, well, we should have said yes there, but we didn't. That's all right. We have homeowners insurance. They'll fix all this. And so you keep it on the market. More people come to see it. But now the offers aren't as good. And now the best offer you get is for $350. Okay, question again. Have we lost money here? Have we lost money? And in some ways, it kind of feels like it, right? Because you went from 420 to 350, and so that feels like a $70,000 loss. But in other ways, right? I guess we still, we're still up from 200. So I guess that's still technically a gain of 150. But it doesn't feel like that, right? We mostly just feel lost because literally last night we had an extra 70 grand. But here's the thing, right? We only lose this money if we say yes and we sell it for that price. If we don't sell it, we don't lose the money. And because we're not stupid and we don't need the money that badly, we decide, hey, we're not going to sell. We're going to wait. Let's take it off the market. Insurance will fix all this. They do. They come in, they fix the roof. Siding was destroyed. They can't color match it. They got to do all new siding. House looks amazing. Put it back on the market and you list it again. And eventually you get an offer for $450 6 months later. And so you went from 200 to 400 to 420 to 350 to 450. So there we go. That looks great. Have we gained any money here? Only if we say yes and sell it for 450, right? So, but here's the deal. Have we lost money here? Not really. Only if we say yes. Instead, what we say is, hey, we haven't lost money. Instead, we've had a temporary decline in value. And in the same way, we haven't really gained money until we sell. But if we wait for that temporary decline to come back, that's when we can actually make money instead of losing it. And the only way to turn a temporary decline into a permanent loss is to sell when the value is down. Let me say that again. The only way to turn a temporary decline into a permanent loss is to sell when the value is down. We need to wait until the value is back up, and then we can sell it at a gain. And so in the same way with your businesses, what was her name? Sorry, Jennifer, with the businesses that you own, right? They're not stocks, these are businesses. The values, they go up and down because they're based on what people are willing to pay. And sometimes people think they're willing to pay a lot less because of uncertainty. But we know that if they're good businesses, the value will eventually come back. We don't know when, we just know that the values will come back. And we only lose money if we say yes and sell them for less than they were worth before. You're still making money, especially compared to, hey, if you put it in, you could have put that money in bonds. And yes, it would have been way more stable, but you would have way less even at the bottom, right? But more importantly, if you just wait, we can sell it later when the value has recovered and we capture all that gain, right? So yes, we still need equities in retirement because that's the only way to make real money. Bond stuff don't make enough money to sustain, and we never lose money. We only have a temporary decline in value, and we only lose if we capitulate and sell. So that'd be the main thing we want to avoid doing. Now, this is all part of strategy. It's actually outlined very well in this book, 3D Retirement Income. It's kind of the whole basis of the book is equity versus fixed income investing. You can get that for free in the link. You can just find it on Amazon and buy it if you want to do it that way. Or you can pre-order this one, right? And you get all of these for free. So that's pretty cool. We're just trying to help people, right? And some of you might eventually hire us to be your full planner, which is fine with me. But even if you don't, we hope that this helps. And we don't want people to do this ever. We want them to do this. And so we don't lose money, Jennifer. We have a temporary decline in value. And the only way we turn a temporary decline into a permanent loss is to sell when it's down, which means we need the way not to. Because part of it could be, hey, if you had to move, back to the house situation, right? Or their house. If you had to move, we don't have a choice. We have to accept whatever. Then you would have to accept this and we would take that loss, right? So you would need options. You would need to say, hey, we need to buy another house, but we've got enough money where we can pay a double mortgage for a while until we can sell it later. And yes, we may be paying extra and paying 2 interest loans and all that stuff, and it might hurt us a little bit, but we know it's not going to hurt us as much as taking this loss, because eventually we'll make so much more money that will more than make up for the double home payment. Right? So in the same way, yes, we want equities in retirement, but we need a way to make sure that we never have to or forced to sell when it's down. And that's what the strategy is all about. So you can get both of these for free, audiobook and hardcover. Links in the description. So hopefully that helps.